All right, good evening, everybody. This is Ken at Tortoise Capital with the nightly strategy podcast for April 22nd, 2020. I have to say that it's almost like Groundhog Day. I had no idea what day of the week this thing was until I remembered that, I heard the trash trucks outside and they come on Wednesdays. But this is one of those where, working from home and I don't really take days off that much, and so every day can kind of easily blend into another if I'm not careful. So you got to monitor that yourself too, and make sure that you're getting, enough changes of scenery and orientation that you're staying fresh and alert. You almost got to program that time in. I am darn sure that I make my nightly walks and my afternoon walks with the doggies. Turns out that they don't really want to put in the 10,000 steps I do every night. So I take them for a shorter walk, let them get their steps in, and then I go finish my longer walk later in the evening. So you got to still take care of the physical plant and the emotional plant. I've been reviewing some work on flow states and psychological states and the importance of oxygenated blood and exercise as a way to quiet the inner chimpanzee and allow the focus to come into play, and the you almost need to have that chattering mind quieted and to allow your deeper mind to start doing some of that reflective learning, and which is what you get from those flow states, like from walking or long distance running or biking, whatever. So I would just encourage you guys to keep up with your fitness and nutrition and sleep patterns and all that in this time of the virus, because this is it. We're in this for the long haul. Okay. So here's where we are today. Let's get our little cursor drawn here. So we finished yesterday with the rejection of the 10-day high, and the peak of the RL10 had rolled over, and we had a disappointing day that penetrated the dragon and closed, gap down, penetrated the dragon, closed poorly near the low of the day, and then we made sure that we had figured out our support levels on the way down. We updated our projections of the current trend lines, and we saw that the current trend, the 10-day extension of the dragon, was starting to underperform the RL90, and so this was showing that the second leg was slowing down and coming into the station, if you will. The PSAR extension is still solid, so there's still some room. There's $5 or $8 of protection still built in, but it was clear that the runaway enthusiasm of the first two legs had come to a natural pause, and we're treating this as a really important turning point, a critical state in which a move higher or lower in sharp moves would not be out of the ordinary. That would sort of be the expected, the least surprising kind of move. We saw the Bollinger Band mean down here, and almost halfway up to fair value around 303. We were still in the summer, but we noticed that the MACD line had started to flatten out, that all it would take would be 1 or 2 more days of selling, and then that summer would roll into the fall, and then our long bias would be weakened by the fact that MACD had had a seasonal change. So that's kind of where we were at the close of the day, and where we ended up with was here. Now, before I get into this, I made some stylistic changes today, and I want to run it past you. It's a subtle difference, but it already feels cleaner to me. So what I did was I took some of this dog's breakfast of clustered indicators from the right-hand side of the chart. Come on now. Yeah, I took a bunch of this clustered stuff that seemed to kind of be getting in the way, and I wanted to unpack that a little bit. And so what I've done is made some style changes that I think cleans up the battlefield. So I want to draw your attention to that, to see if when you make subtle changes like that, quite often that will make a difference. And so I want to just run that past you and then see how you feel with it. So one of the things I wanted to do was in TC2000, I made the, instead of these just horizontal lines, I made the horizontal lines very, very paper thin so that it would still show the price levels of these various elements, but made it really paper thin. So to try to open up some of this view of the previous price action. And then I anchored a thick trend line between the source of whatever the support was and then bring it over to the right. And then I overlaid that over that thin line. So you could still see the price, but now you can see where each of these support levels is originating. And I think that way it kind of reinforces the lesson of what things that I'm looking at and what is the source of support. And then that acts almost as a teachable moment. So, and then what I did was I broke out the 1 day, 10 day, and 30-day ranges. I broke out those and anchored them. So the 30 is over here on the 30-day look back, and it stretches from the high to the low. And then the 10-day from the high to the low. And then I made today's range stand out a little bit more so we could see the context. And then I just cleaned up the 10, 20, 30, and 40% sell-off. So hopefully this will clean up the close-in view a little better and make it a little bit easier to read, and then also reinforce some of the lessons. So here was today's trading range. So it took yesterday's range that we were worried about it, where it had closed down here. It actually had a nice gap up, the smallest range of the last 10 days, and closed on a slightly positive tip. So that was actually a pretty good day at the end of what was, we were starting to get a little gloomy about, at least I was starting to get a little gloomy about this. So the high of the range of today was 281.43 down to 276.46, and it closed right here in the black line at 279.10. So it was actually a pretty positive day, all things considered. Not a runaway to the upside, but it didn't lose money. It held its support. It had low volatility, so there was not too much pain and suffering. It was failure to fail further, and it actually kind of is a pause that this is almost like a train that has come into the station. I think of this as leg one journeyed from the reversal of the RL10, made a P1, crossed there's your RLXD, came in and held support at the edge of the dragon, resumed, made another leg of about the same excursion up here to what was now the 10-day high, has had kind of a 2-day sell-off, and then put in a nice consolidation day on limited range. And there wasn't a lot of good news, but the absence of bad news and failure to fail I treat as a positive sign. We're still not quite yet at Monday's opening, but we made up 3/4 of the ground, and now we're still postured to take out tomorrow's high, to get back, which also coincides with the upper skin of the dragon. So that thick green line is a significant one. And then a price move up into there would get us on the correct side of that dragon extension. Now, what I did was I made that the spine of the dragon, I extended that forward with a thin orange line so we can still feel the short-term slope of that we have to beat. We want to be above that line to have a positive feeling about price. So that's going to be an important support line. And then the RL30 extension, I just took the last 2 days of the RL30 and then extended that. That's this one. That's really, we want to get better than that for sure, to get back in line with the powerful longer trend. And then the PSAR extension, I just take the last 2 dots and draw that thin line extension. So that gives me 3 anticipations or forward-looking projections based on the mathematics of those three different ways of looking at trend data. And it gives me just a way to start making sense about the expectations of future price. I still, then what I've done is I've made that line up to the fair value thick, and then I've evaluated, the price action between the 10-day high and the fair value, and there's nothing in here. There's nothing in here looking back 30 days. So there's no real resistance between the green line and that fair value. So if this holds true, there could seriously be a third leg up that gets to that projection, that fair value, and that would be in line with the strength of this buying pause, and the sellers have not really manifested yet. I would also notice that I'm going to show you another chart here in a second, but I just want you to notice that I sort of have this belief that we can trade between the P1s. So a P1 is defined as, that's pattern 1 in the RLCO framework. And what that means is after a significant move, after an unambiguous move, which remember is the first criteria of the owl. What do we mean by that? Well, one thing is, I want to go back and look here for just a minute. When we go back to the edge of the river, we say the definition of the beginning of a trending move is when price, the 10, and the RL30 all leave the river. Well, that all happened right here under the purple dot. That is the beginning of this downward trending move. So when that happens, you have price leaves the river, followed quickly by the 10, and then the 30 departs the river. And then you notice that the dragon has swum quickly over to the side of the river and parallels it all the way down. Well, we never know how long that trend is going to last, but we know that's the start of trending behavior. And that trending behavior, in my view, happens until the RL10 reverses and crosses over the RL30. So once the RL30 leaves the river, it's not going back into the river until there has been a considerable change in price action, right? So let's just trace the RL30. It has rolled down. It's out of the river, rolls over and gets flat. Now it's coming back towards the river. Here's the skin of the river. And it doesn't re-enter the river until here. So this is officially the ending of this downward trending behavior. That's when it's officially over. And then the downward trend is convincingly over when the RL30 crosses the Bollinger Band mean, which happens right here. So if we look at the RL30 as the health of the trend, which I do, I interpret it as, the subtitle is the RL30, the health of the trend. The health of the trend is it begins downward trending behavior here. It bottoms out here and gets flat. And then it starts to roll up here. So we know that when the RL30 rolls up, that is the fifth criteria of the owl. And if we look up here, we see, oh yeah, there's an owl entry right there. So in the life cycle of that health, we have a downward trend. The price and the RL10 are rolling down. The RL30 is lagging and rolling down. And that the first alert that is over is when the RL10 crosses the RL30. That happened on the second day of the price reversal. That's also a 1, 2, 3 exit. So legitimately, where that orange dot is when it crossed the spine of the dragon or made the 1, 2, 3 exit, you could legitimately get out right there. I want you to look down and notice that was also the time that the MACD histogram went from winter to spring, well outside the Red River, which means that the magnitude of this trend was large, that the short-term move was sharply away from that. Because what the MACD histogram is tracking is the difference between the 10 simple moving average, the dragon, and the 30 simple moving average, which is the middle of the river. And you can see how that's getting wider and wider and wider, and that's why you get a winter, deeper and deeper and deeper. When that starts to reverse, it rolls into the spring pretty quickly. Well, so that P1 is really your first alert that that longer term move is over. Now, we're not going to get the beginning of trending behavior to the upside until three things happen. Price has to leave the river on the far side. It happened over here. There's price leaving the river. This is where the RL10 actually got out of the river first because it overshot a little bit right here. How interesting is that? So right here you have both the RL10 and the price are out of the river. And then the beginning of trending behavior occurs when the RL30 leaves the river. And guess when that happened? That happened today. Now, if today had been a selling day, that RL30 was getting flatter and might have rolled over and it might not have gone out of the river. But the fact that today was a positive day and low volatility leads to the conclusion that this is the beginning of trending behavior on the far side of the river, because now you have price, the RL10 and the RL90 or RL30 all out of the river and everything is sloping upwards. So all we've got to do to have the beginning of that third leg of the trend is a continuation to the upside, which would start. So imagine we got a price opening inside the yellow zone, today's range, and then it takes out today's high. It gets above Monday's open. That means it would have erased all of the negative feelings of this penetration from Monday. So it gets above Monday's open. That's a positive sign. And then it breaks out above the 10-day high and the hump of the RL10. Dude, it is free and clear if it gets above 288. And then all we have is, we don't have any price resistance all the way back. All we have is the statistical measure of the floodplain and then the long-term fair value. So that's actually pretty cool. So that's the upside. Now on the downside, so this is where you can now see we'll be able to just track using this new layout, the sources of support that need to hold. Now these sources of support are also price targets on the way down. So when we are framing trades over these swing trade timeframes, then these are the price targets that if it gets there and hesitates, then we execute the 2-hour battle drill and capture the profits. But if it breaks through, then that's actually places where we can think about like a collapsing dragon. I want you to hear in your mind the sounding of the floorboards breaking. So like when a building is on fire and that fire starts weakening the structure of the building, when those timbers break, that's the sound of guys at price crashing through the floor, and it's going to run until it gets to the next floor. Well, these thick red lines are all the floors in this stack of support levels. Each one of them is a place where it could hold, should hold, has held, but if it doesn't, it then cracks and then it falls quickly towards the next. This is like on the Autobahn in between those different cities along the Autobahn. That's high speed between the red lines, and each red line is an area where we would not be surprised if price held support. So let's take a look at these. We have the 1-day low. I'm counting the 2-day low as important on this one because it was also the weekly low, and this was it had held support at this low before and then made a nice run. And then this is also tomorrow's 10-day low. So we're actually anticipating where tomorrow's 10-day low is going to be. So that's why I decided to make that a thick line, because this is the 10-day low for the current 10-day period. Tomorrow it goes to here, and then this will become the new 10-day low. So we're reading ahead. That's also the PSAR flip. And this one is now the PSAR flip and today's 10-day low. Here's the combination of the Bollinger Band mean and the RL90. Look how nicely those things parallel each other. That's interesting. I got to think more about that. So what that tells you is that regression lines are about 3 times more adaptive than simple moving averages, right? Because the RL90 is about the equivalent of the simple moving 30. So that tells you that on that 90 period regression line is about 3 times more adaptive than the equivalent simple moving average. And so the 10 period regression line is even more adaptive than the 30 period simple moving average. So there's really it's actually more adaptive than the 10 period simple moving average. The difference between the RL10 and the spine of the dragon is the difference between a moving regression line, the least squares moving average, and then the simple moving average. So the dragon is always going to be smooth because of math. And the 10 period regression line is always going to give you a very adaptive proxy for price. So the 10 period dragon is the smoothed price trend, and the RL10 is a proxy for price. What the RL10 gives you, it allows you to discount some of the fat tails of the individual days. So when we're looking at these longer term swing movements and we want to get a feel for the real fair price, taking a noise filter, that's how I'm using that RL10 as the trader's price, the swing trader's price, okay? And then these are fractal relationships. You'll hear me talk about that in some of the early lessons in the boot camp. I think it's that important to study this. So let's get back to our red line. So the 1 day low, I'm treating the 2 day low is also tomorrow's 10-day low. So that's why that's thick. This is the PSAR flip and the current 10-day low. This one starts back at the belly of the RL10. So on this move up, that first leg terminated here. Price held support at the edge of the dragon, never even penetrated, and then resumed. So that is really strong support. So that's why that is a thick line. And as you can see, that's at 256.57. The next one down here is I've connected it to the Z-1. That's the price level that is the beginning of downward trending behavior, right? Because you have to get the price. You'd have to see price and the RL10 and then the RL30 roll over and get out of the river to resume a downward trending price action. So that is the current value of the southern skin of the river right now. It's at 243.11. The next one down, we come back to the belly of the dragon, the maximum excursion of the dragon and its downward roll. So this really represents the statistically significant turning point. You can actually discount all of the price action that are in these long tails on these daily prices because the way the descriptive statistics work, this gives you the statistically significant turning point, which is the belly of the dragon. So let's just suppose a scenario in which this price action collapsed and it broke through all of these floors. Snap, crackle, pop, crash, bam, right? Like the old Batman TV show. So we would be justified in taking a short position if it crashed through here. Remember what that would represent? For those of you keeping score at home, that represents the collapsing dragon. A price that breaks through 237.43 would officially be the collapsing dragon. So what that tells you is any short position that you would take between, let's say, 276 and 230, and 243, or 238, 237. Any price action where you got short through here because of the price action of collapsing support, maybe you did some intraday stuff and it kept working and you decided to keep a piece of the intraday and start building a swing position deliberately through time. By the time you get down to this price level, you are officially converting on daily charts from a pocket entry short into a collapsing dragon short. And you could take that collapsing dragon at the belly of the dragon, or I'm even accepting the belly of the 10 as another reason to get a second short position. So both of those two statistical turning points, the belly of the dragon and the belly of the 10, are really important for establishing support levels for trade framing. Now, a lot of people will use the lowest low as the absolute lowest low of this excursion as the swing low. But what I want you to notice is there's hardly any volume being traded down here. So that last little excursion that day was insignificant compared to the massive amount of volume that was traded and inside these price levels. And look at that, price action is all in the red. And that means nobody was holding out for the ask. They were all hitting the bid. So that is the sign of massive sell-off, panic, excursion. It's not until you start working your way up into the stack, here, that you start seeing a battle between the bid and the ask and fighting over the spread. And so this is representative of tactical trading up in here, whereas this is the sign of one-sided turning points, and that's what another reason to believe in this as a potential turning point. And so when we start adopting a careful long side posture here in the spring and starting to use like the RLXD entry or waiting for the owl to turn and hit right here, we're starting to get long side entries as the market is turning and being confirmed by these statistical measures. So I say all that simply, to finish up then, these are the price levels on the way down. And then the final one you see here is this very thick one at the Z3 excursion. So all of these places below the collapsing this was the point I wanted to make. So by looking at, this is the refinement of our RLCO Bollinger Band framework, is that we treat the belly of the dragon as the statistical swing low, and that if that gets violated, then we expect a rapid collapse and sell-off. Like, we're not waiting for price to violate and get below the absolute swing low. We can start adopting short positions here, and we're able to front run those. So if it actually gets through this last red line, we would expect a great big collapse, because everybody that had bought long on this might have had their stop below that swing low. And if price crashes through here and comes and collects all of those stop positions, it would sound like popcorn, and this thing would explode to the downside, the same way that it did on this final culminating bar. You'd see another one of those red Niagaras. So we don't want to wait for that to happen. We don't want to try to chase that. We start using these notions of collapsing support levels and front running it with pocket trading, so that by the time we would be in the pocket until it comes to here, then this would be a collapsing dragon entry. And then we should have 4 or 5 positions by the time it collapses through there. Then if you get this kind of runaway freight train, remember, it's not even the beginning of downward trending behavior till the price, the 10 and the 30 all get below Z-1. So by that time, we would have 4 or 5 positions in hand, in the money, taking advantage of that wave of selling. I hope it doesn't happen for the good of the world, but tactically, that's the side of the trade that I'm paying attention to, because I want to go long. When I want to go long, and I would love to be able to go long, I really spend more time framing the other side of the trade so I understand the risk implications and I understand that architecture in a professional manner, and it puts me in the mindset of the person who is on the other side of the trade from me when I'm trying to go long. The upside of this thing is really easy to see. The size of the move is the equivalent of just cut and paste these moves. This is from 256 to 288, so that's $30. So this thing gets to 315 in a hurry, and then by that time it's it's an academic exercise because we will have had good positions in here, and it will be obvious, that this thing has fully recovered once it gets through this area of no resistance. So that's how I am interpreting this price action. So we just spent 40 minutes talking our way through a deep understanding of the S&P as the market. Now, why is that worth doing? In our understanding, it's worth doing because 50% of the returns of anything that we're trading in my style with sectors and large caps, things that are aligned with the market, 50% of those returns can be attributed to what the market itself is doing. And the market itself is the S&P because it has such an enormous amount of money attached to it. And that's why understanding the market at a deep level sets you up for further refinements when it comes to sector trading and individual target trading. That's why it's worth understanding what it's doing. And because the patterns that we have are fractal, when we start looking at our other charts, we're looking for things that are strongly correlated with the S&P are going to kind of look like this. They will have had two levels of return, are postured inside their river, in their dragon, ready to break out of the river. So if we look at a chart that's not that good, then we know we have something that is lagging the market. And then if the market rolls over and then that laggard is worse, then that's auto short because it's already weaker than the market. And then whatever support the market gave it is undercut. That thing's just going to fail again. So we can use our market understanding and interpretation in order to help us find sectors and targets to be able to trade short. And that's what I want to do, find the mover. So hopefully this gives you an appreciation for the trade architecture and trade framing. I want you to look at all of these price levels and support lines as trade framing and scaffolding that help us construct a sense-making methodology to interpret price action. Now remember, these are just beliefs. And this is just one way of looking at the market, but it gives us a consistent, coherent, complete, integrated look at the market in all time frames that are based on statistics, which are adaptive, and which therefore is not what the herd is doing, which automatically gives us an interpretation scheme that can add value. Okay? So I just kind of want you to digest all that. And then if questions come up, you can send me questions, and I'll try to say it again in a better way. So that's the essence of core and turbo, and it's built on these ideas of fractal patterns. They are fractal in terms of time and target. So by target, I mean that you can a pattern that is in place for the market is interpreted the same way in a sector, is interpreted the same way in a target. And then if we switched up to weekly and monthly charts, the interpretation of these indicators and how we would view the meaning that we attach to these descriptions is identical. That a Z2 excursion, a turning point at Z2, is identical whether we're looking at monthly charts or minute charts. Okay? So Frank asks, is the owl on the SPY chart at the third candle inside the dragon or at the next candle? So I would take, if you were intraday and you took, there is about a 2-cent excursion on this third candle above the second candle. If you took that as an owl entry intraday, I would not be offended because your stop is down here at the red line. And you're getting a really good, the closer your entry is to your invalidating price, the less you're going to lose per share and the more upside you have. Excuse me. Pardon me. It's better to be sneezing than coughing at this point. not to make light of it. But this candle, this fourth candle here, is clearly an owl entry. I would be willing to take either one of those. So you're either going to get at the tip or right at the open, either one of those. So there's really only a $1 or $2 difference. Now, if you were trading like with hourly charts, you would actually be able to refine that even more closely and take a smaller position because the hourly charts would have front run that a little bit. So you could actually take an initial position on the hourly charts with 1/3 of what your final position could be. And then when you dial up to the daily charts and you could add to that with the daily, you can now be fractal in time and lower your risk on things that are closer and closer to the turning points. And that's also part of the idea behind Core and Turbo, is that on the intraday, when your margin of management is much tighter, you can get the same position sizes with much smaller adverse price action of risk and much tighter risk management. And then if it works in your favor, you can make your money much earlier. Like on this day of expansion, that move intraday absolutely pays for all of the swing trades that are generated on daily charts with this owl. Just that one day alone. And then when you get that big gap up on the second day and it starts selling off, it becomes very easy to make bank on the larger intraday trades you have, even if you're trading on something as slow as 2-hour or 1-hour or 30-minute charts. That's very relaxed management, and it gives you an enlightened swing view of the market. So that 30-minute, 1-hour, 2-hour time frame is a nice way to straddle fast day trading and slower swing trading. It gives you a way, a 30-minute chart is either a very, very slow swing trade, a very, very slow day trade, excuse me, or it's a very, very fast swing trade. And same thing with the 2-hour. Okay, so that's what I wanted to say about the market. Now, I want to just shift your attention and show you a different array of the same price action, but with a different point of view. This is a discussion of the green, yellow, red concept. And so this is a snapshot from intraday. And I put this out as in the master class, just as one of the things that happens, especially on a really quiet day like today, is that not much is happening. So rather than trying to force the market to work by making things happen, by trading a lot, I just kind of step out and see what's going on and try to put the day in the context of, say, if it closes where it is, what kind of day would it look like in retrospect? So I take off all of those other lines and whatnot, and I just go to a different. I just go in TC2000. I just turn off the drawings, and then I take a screenshot, and then I tart it up with some of these easy to draw highlighters in Snagit, and so in about 10 seconds, I can get this, what I think is a pretty way of looking at the market. So here we are in daily charts. The yellow zone, notice how small that little rascal is. I think of strategic, operational, and tactical, right? So if it breaks out of today's range, let's say it closed in that little doji today. I'm going to zoom this up a little bit more. Excuse me. Patience. If it closed right where it was, this was around lunch. If it closed where it was, it would be that really tight doji inside the dragon, and that's actually where it closed. On either side of it is the first easy move, not easy, but the first tentative tactical move out of today's yellow zone towards the next measured level of resistance. In this case, I've drawn the pale green upside to the hump of the RL10. That's the first piece of resistance it has to get through. But if it could get through there, then the next run up is to that fair value. And again, there's no price action in the last 30 days to act as resistance. So if it could get through this tentative green, it starts getting into the operational move. And then if it can break above that fair value, which is also the hump of the 10 back here where it collapsed the last time, then it would be free and clear. And then the next thing is it runs all the way back up to the previous hump of the dragon and the all-time high and the hump of the RL10. So I almost think of that as good, better, best, of increasingly more confidence and gains to the upside. Tactical, operational, and strategic. This is long-term money that's kind of correlated with that RL270, the long-term buy and holders. That's what those guys think the fair value is. They're not even worried by this stuff. Listen, when you're an international banker and you know that the Fed is never going to let civilization end and that they're going to come in and bail this thing out however deep it gets, you're not worried about this. Your estimate of fair value is only modified by about 8%. That's the advantage of being connected in the players club, those rat bastards. You think they were sweating this? Hell no. They got health care. They have testing stations on Billionaire Island. It's a big club, baby, and we're not in it, Jimmy Dore would say. Anyway, so that's good, better, best. This is that long-term opportunity money. And when the Fed came in and made this turning point, guess who's benefiting from that easy money? It's not easy, but that's $6 trillion in the promise of more, making this recovery back to something. Now we're in this tactical zone coming back towards fair value. So on the upside, good, better, best. And so on the way down, the corresponding symmetry would be bad, worse, worst. So if it breaks down from the dragon, that pink zone is from the skin of the dragon down to the PSAR flip, which we also know as the 10-day low. And maybe the Bollinger Band mean, so somewhere in there. I'll just call it the PSAR flip. But if that cracks, then the next thing that is this pocket entry. Remember, this was all the pocket until the belly of the dragon? That's the pocket. This is tactical trading. This is swing pocket short. And if that cracks, this is a second pocket and then if this RL10 and the final PSAR cracks, this thing that's minus 40 from the swing high, and there's another 20% down to the downside. That's how far it fell in the internet bubble, by the way. When that thing cracked, it was an 80% sell-off, 58% in the S&P. This is only a 40% excursion. So you could make the argument based on history that that's leg one. And although I like this and I want to go long and I'd love to see this, hey, if this was just a rollover opportunity, and that's what that is right there, there's a lot of people making that bet. And I'll be ready to trade that in measured steps on the way down. I'm not going to get hurt. And I'll make some money in there. But that's all about tactical pocket trading on the short side. And so if this is good, better, best, and this is bad, worse, and worst, where we are right now is at the end of a two-leg move, 1, 2, culminating in the tiniest little doji of the last 30 days. That's the smallest percent range since all the way here. That is so small, it almost looks like this when everything was easy and normal. Remember those days? That's how tiny today's range was. So much like a coiled spring, you could expect this to break out and start gathering steam. And as it starts getting into either the green or the red, it will attract momentum and off it goes. So this is one way to look at it from an architecture standpoint with all the red lines and all that jazz and calibrated moves. And we're putting some science and craftsmanship on here. We're measuring twice. This one with the color codes, excuse me, this one with the color codes, is the relaxed, artful feeling, the art appreciation side of this. This is the artist's rendition. The other one is the craftsman's blueprint, the general contractor's blueprint for how to turn this into reality. But this is the artist's rendition of what could happen in the future. I'm not putting any probability on there, but I would just say it's a coin flip based on the fact that we're at the end of a second move and in a doji in the middle of a dragon, and we went from a P1 here all the way up to a P1 there, and we're in the middle of the dragon in a tight range. That's a coin flip. And anybody that thinks it's otherwise, you know something that I don't know, and I don't know where that confidence would come from unless you're an insider. So that's the artist's rendition. So that's what I want to say about that. Meanwhile, let's get back to work. So here was today's price action. This is the S&P at plus 2.15. What was better? Apple, Cisco, Brazil, tech, energy. Wheat and precious metals was massive goodness today. Tesla, Alcoa, Devon Energy. Now look at this. Devon Energy and Alcoa are up 7 and 8%. Devon Energy's up 8% when energy's up 3.5%, when oil was down 10%. What? Yeah, that's how good Devon Energy is as a company. Very well run mid-cap U.S. energy and energy services company. That's why I love those guys. Alcoa had some nice moves. Tesla rebounded nicely. Wheat and precious metals. Okay, so that's everything that was better. Energy, tech. Yeah, energy and tech. What was worse than the S&P? Marginally, materials and the Dow. Not much worse. So still pretty, it's almost a tie. But then Eurasia, Japan, and as I go down the stack, they're getting worse and worse. Healthcare, real estate underperformed. And then I always go look for commercial real estate, which was down 2% on a day the market was up 2%. So there's healthcare, real estate, finance, small caps, lumber, Mexico, Cliff, U.S. Steel is getting crushed, commercial real estate, and then oil just gets smashed. Now, here's the anomaly. This is why I had to get out of those swing trades the other day. On a day where oil is down 10%, the triple inverse oil, which should be up, is also down, and it's down 15%. What? Yeah, that's just based on the nature of that contract and that ETF. It's just weird. So that was the sector performance. On a day where there's been a pullback, so remember where we are. We're on a pullback and a tight range, and then the 10-day high is a target, and then there's a pullback with a tight range. You're going to see a lot of candidates on these two charts. This one is the auto framer. So things like American Express, 8-1, Caterpillar 6-1, oil 5-1, Coke 4.5-1. These are all must-own things, and you can make a very structured mechanical entry into these things if we get an upward moving market. So these things are all the ones that are better than 2-1 out of my stack of interesting topics. The things other things I look for, finance, Disney, Boeing, materials, energy, Brazil, the Dow 30 is at 2-1. And then the squeeze, these are all the ones that had such a narrowly configured range today that if it just makes a range stat move, you get this incredible one-day pop. American Express, Walgreens, emerging markets. Look at all the big indexes that are on here. That's how tightly compressed today was. Dow is on there. That's all you need to know about how tightly compressed this thing is. Dow is a one-day pop. Brazil, the S&P, finance, small cap. So the entire market is in that same kind of condition. That is why you got to pay attention to the market, because all of these things that are tightly correlated to the market are also postured in that way. The final lesson for today is going to be about 10 or 15 minutes, and we're already about 50 minutes in. But this one's pretty good. This one is a discussion of how to do core and turbo in practical terms, what this looks like over a 2-day period with, and I happen to be using Tesla. So what I want you to notice, the first thing is we're going to be on minute charts, and this is going to be a 2-day excursion. Oops, excuse me. This is going to be a 2-day excursion on 1-minute charts. I want you to notice that that the background is yellow. That means that if we went over and looked at that on its daily chart, on daily candles, that we're inside that kind of tactical trading area. So we're inside his yellow zone. So the first thing that happens, so here we go. So this is Tesla, and I have a short side bias on it, I remember, from the swing portfolio review. And the first thing I notice is this. I'm just going to leap ahead here kind of quickly. So I noticed that it closed near the VWAP 2 days ago. And maybe this was, April 21st it closed. It closed at the VWAP, and then it had a small gap down, and then it recovered back to the previous day's VWAP. That's the VWAP magnet. And the closing of the gap trade from 1 to 2. I didn't trade that, but that's a trade. And then the move from 2 down through 3, all the way down at 3, what we have, it was a temporary bounce up and then sells off immediately. So we have a high at 2, a lower high at 3, and the dragon rolls over. And now notice that we're 30 minutes into the day, and we have a Z3 pinch, and it's collapsing down here. So what I do is I just go to the Z3 excursion, because what I want to do is get a swing trade on this thing. So I just take that Z3 excursion, and I'm going to enter it 4 as a collapsing dragon. And what I'm doing on this is I'm adding a swing. I'm taking a swing trade position and a intraday turbo short position. So I just want to use this in a ratio of 4 to 1. Now, your ratio may vary, but just imagine, if you will, a 200 shares short for the swing and 800 shares short in this symbol on the intraday. So that's a 4 to 1 ratio. So I have I have equal dollars at risk. There's one bullet coming out of each of those buckets. One from the core, one from the intraday. The core, so right now at 4, I'm short 1 swing position core and short 1 turbo position intraday. So I've got 1,000. If you had a 5 to 1 ratio, it would be short 200 swing and short 1,000 intraday. That would give you a 5 to 1 relationship, and that's fine too. Maybe that's easier to understand. Or short 100 swing and short 1,000 turbo. Maybe that's use a 10 to 1 ratio. Either one, any ratio that you want is fine. This thing, after it collapses through the Z3 excursion, this is why I tell you that when the previous Z3 line breaks, what that tells you was That was the price level that during this move from 1 to 2, a reversal of that magnitude would be an extraordinary psychological collapse. That's what a adverse Z3 break means. So I have no compunction about getting large short at 4 because it just broke the previous Z3 adverse excursion after it had already put in a nice move all the way to the top. What that says is a breakdown through 4 absolutely negates that previous day's close and VWAP. This thing is just in full collapse. And then look what happens. When that breaks, it is running like a scalded ape. It has a quick rebound inside the dragon and then fails again through the RL10. That's a second position at 5 on a second collapsing dragon. So here's what I do. I keep the core position on, and I just put an additional swing, or I'm sorry, I keep the same swing position on. I put in an additional turbo position intraday. Now, I would not be offended if you put a second corner, but I don't like to do that. I like to just have one swing position and just leave it the hell alone. So now I want you to see that at 5, let's say I'm using that 10-to-1 ratio. So now I've got 100 short in the swing core, and now I've got 2,000 short turbo. It makes it run all the way down here. I want you to notice what that adverse excursion looks like. The distance from 4 to 5 is the first leg. This distance from 5 to the tip of the red arrow is the same size. So that is leg 1. You see leg 1, you plan for leg 2. That's why you get short the second one. You hope for leg 3. It didn't give me a third leg down, even though it was deep in the winter. In fact, it rebounded halfway up, and at 6, I am content because now I've got 2 full turbo positions on deep in the money, and that's going to pay for my swing trade. So here's what I do at 6. I exit both turbo positions short intraday, so I cash 2,000, and I keep 100 short. Now, the risk capital to fund those 100 shares short is paid for by the money that we just earned on those 2 turbo positions short. And when I look at what my risk is on the core, my core position here was short at 4. I don't mind if you use the red line as your swing exit so that you don't lose money on that. I don't mind if your initial swing was an ATR or 2 ATR, whatever it was, but you could easily pick the blue line, which was the initial turbo risk, and just make that your core swing position risk and never lose money on that trade. So either the blue line or the red line, I'll let you take your pick. Both of those are on the other side of the VWAP, so you're really safe. You can just leave that core position alone. And if you got out at the red line sometime today, you just broke even on the core. You didn't lose any money. Make that no lose plus dinner for 2. So now we got 1 short position in a swing trade. And now the rest of the day unfolds. I don't care. I don't care. It rolls over at the VWAP. Here's your VWAP magnet, by the way. If you were an aggressive Tesla trader or you wanted to keep trading this thing during the day, look, you got a Z3P and a breakout and your target is the VWAP. It did that twice and then rolled over. So now I really feel good. It's 3 p.m. and now on the basis that it rolled over twice at the VWAP and there was no buying interest to try to make it move north, I don't mind holding this core position of 100 shares or 200 shares overnight. So with an hour left in the day, I make a decision, hold that position. Sorry. Let me get that. So at 7, it closes finally, and I notice that unlike yesterday where it closed at the VWAP and then gapped away, this one closed a long distance away from the VWAP to the wrong side. So I feel really good about this swing short. But I also know that if that's what people are treating as the VWAP, there might be a sharp rebound tomorrow. But I don't mind. My overnight stop is either going to be here at the red line. I chose the blue line and I said, look, if this is where it closed, any gap that is south of the blue line just allows me to manage the trade. I'll make a decision. But if it gaps above the blue line, I'm going to instantly exit my swing position because it violated that architecture. So I chose my overnight swing risk to be the blue line. It was also the price that was my initial turbo risk on this very first trade at 4. That's where my turbo risk was. So that's what I'm choosing as my swing risk. So here's what happened today, the 22nd. And I'm just going to uncover this in the interest of time. All right. So what it did was it, let's see, it gapped up here, rose up to 8, and then rolled over immediately and collapsed through the VWAP at 9. So all I did there was it rolled over at the same level it rolled over yesterday. And yesterday when it rolled over, it gave this huge move. So at 9, I just put the turbo position back on. So this is what I do. I notice that it gapped up to yesterday's VWAP and then collapsed. So I add my little 1,000 shares of turbo short again, or whatever multiple it is that you're holding. I'm using 100 and 1,000 to show the ratio. I don't have 100 and 1,000 shares of Tesla. I'm not putting that much money in of capital, but the ratio of the size of your position is what I'm getting at. So at 9, I put the turbo back on. It falls all the way down to 10 to a price level where in the last 2 days it has held support and then recovered. So it gets all the way down to 10, starts to reverse, and then I take the RLXD exit turbo right there. So my trade from 9 to 10 is in the money, and I made money today on the turbo trade. And now all I have left is a core position short. It then resumes and gets all the way back up to 11 to the VWAP, and then this is what I notice. The rest of the market, it is strong today, and tech is leading the way, and Tesla is strong. So I just say, you know what, my swing exit short, I'm out of everything now at 11. So my swing trade turned out to be from 4 short all the way down to 11 covered, and now I'm flat at 11. And here's what it does now. It just mucks around and goes sideways and creates an observable sideways quiet channel around 12 and the VWAP, which is right where I got out at fair value at 11. So now I have no position in this thing, and I see a sideways quiet channel breakout. Let me uncover this thing. Sorry. Dang it, it just collapsed. The editor just collapsed on me again. Sorry. Craving your patience. There's only a couple minutes left in this lesson. So if you can still hang in there, we'll get this thing opened up again in a hurry. Yeah. So here's what ended up happening the rest of the day. So 12 is where the that VWAP happened. The VWAP magnet trade comes back to there. It gives us a sideways quiet channel. Get my cursor back on here for you. Hold on. We get long at 13. We get long at 13 on a Z3 breakout VWAP cross. We use maybe a Z3 or belly of the dragon, belly of the 10 as the initial stop on the turbo. It makes a move up. It holds support at the PSAR. It then I draw this line across at 14. This is the Z3 excursion breakout to the upside. So we get a second position in at 15. It makes a big fast run up, and then we take the RLXD in the last hour of the day. So we get two positions in turbo and then just cash. And now I'm flat overnight. And all Tesla has done in the last 2 days is go from here around 1, and it closed at the same price level. But we've been able to trade this in both directions based on our read of the market and writing the patterns and the probabilities in an absolutely standard way. So when I talk about core and turbo, that ratio of 1 to 4, 1 to 5, or 1 to 10 to show the relationship between the size, that's what I mean about using the intraday moves to generate the capital that allows you markets money to be willing to hold a much smaller position overnight. Then as long as the swing trade is working, you can go back the next day and reinforce it, or you can use the intraday price action to help make your decisions about where to get in or get out. As you saw me, I decided to exit the core short in Tesla after it had moved from 4 down to 10, and then I just got out at 11 because I just wanted to get flat, because it looked like this was a great big turning point when you look at this from a far enough back. So that's what I mean by adaptive trading, core and turbo, fractal patterns, and relaxed money and markets money. Okay, so that's everything I wanted to cover tonight, guys. Send questions if you have them. Hang in there. I've already got the daily report is posted at Patreon. You can download it from in here under the handouts section. And then I will have this thing processed into a couple. There's probably 2 different lessons that I'll carve out of this one. One of them was the interpreting the market, and then the second one is that core and turbo lesson. And then I kind of already like the way that new painting and formatting on the daily health check. I kind of like that already, so I'll clean that up a little bit more for the green lines, and then and maybe label those, and then we'll have a nice, easy to maintain template that is standard as we go forward. So we'll just continuous improvement. So take good care, guys. We will see you in the chat room, and keep up the good work.